Welcome to the Property Mindset Podcast. Join us as we dive into the journeys of successful real estate entrepreneurs, gaining personal insights, practical tips, and valuable tools for your own real estate adventure. Whether you're new, experienced, or just love real estate, this podcast is for you. Tune in for engaging and informative conversations with the brightest minds in the industry. Welcome back to the Property Mindset Podcast with me, Phil Gadd. Today, I'm excited to be joined by Joel Labonte, who is a multifamily investor. We're going to dive into how Joel goes about finding the right property. If you're looking to get into multifamily or you're looking to expand your portfolio, hopefully today's conversation will be of use to you. Welcome, Joel.
Thank you for the invitation.
Appreciate your time. So like I mentioned, I think we're just going to chat about, maybe you could give us a little background, but how you went about finding your first property and how people listening who may be thinking of getting into multifamily investing or people who want to increase their portfolio, getting themselves a little bit stuck can get some value.
So a short break from our show sponsor, eXp Luxury at First Tracks Real Estate Group. Imagine a real estate experience where your luxury property isn't just seen, but showcased, both locally and globally. eXp Luxury is about more than transactions. It's about transforming how high-end properties reach the market. With a blend of unparalleled global exposure, cutting-edge marketing strategies, and an elite network of professionals, eXp Luxury ensures your property stands out in the luxury market. Phil Gadd and the First Tracks Real Estate Group leverage his platform to elevate your listings, ensuring it reaches its full potential. Welcome to the new standard in luxury real estate.
Yeah, thank you. First of all, I started around 2019 multifamily, and it's something I came upon since I am a flooring contractor here in Canmore, Alberta. So the physical aspect was not really strange for me and quite comfortable. And I was looking for something aside of my company just to try to retire myself from the trades since it's getting hard on the body. Real estate in general was appealing to me. We already had a rental property in Calgary that we had suited. I was looking for a different business and real estate was the answer. I discovered a podcast back then, like yours, that were talking about real estate. And that's where we open a little bit our mindset to multifamily and learn a little bit about it. And at that point, some program classes or mentorship showed itself. I went through the learning process of underwriting the deals and what to look for and where to look for, analyzing the market, analyzing everything. So we could make an actual proper decision on what to buy, where to buy it, what not to buy, and what to look for as well. That's how I went about it to start. In terms of to find the properties, there's many things to look for, many strategies you can go about. I guess we can talk about that a little bit as well.
Absolutely. I think we should start there because you're right. Determining what strategy you take will help you decide on what sort of properties you end up acquiring.
That's right. There, you can buy a property, right? But you can also buy it for future value as well. We specialize more in what they call value add, where you're going to buy a property based on the actual value, how much money it's making, and forecast that in the future you can increase that income to increase the value eventually. As some might know, a property, a multifamily is like a business. It is a business. It's a income generating business. So it's bought and valued as such. So to understand like the matrix and the numbers, how to run that, it's very important to buy the right property at the right price.
That's very interesting. I think that's one of the reasons why I'm attracted to multifamily myself is the fact that it is a small business. Essentially, you purchase, you're looking at it as a kind of independent little business generating its own kind of revenue and net profit. So when you're looking at deals, what are you ultimately looking for? Is there a quick process you do to establish if a deal's worth pursuing more? What's your kind of strategy there?
Yeah, now it is a fairly quick process, but it didn't start as such. At first, you need to do enough and see enough property, do enough underwriting to actually get the sense on the okay, what expenses should be and what rent should be and in what market do you want to be, right? Now we're in a situation where the real estate broker are bringing us the opportunity, and we don't necessarily have to look for them, which is a good position, but that's not how it started. Originally, what we had to do at the beginning, when we really decided to make it as a business, to be a real estate investor in multifamily, is to reach every broker that are in commercial and residential in some smaller market, to be on their list, to get the listing. And the idea is to get it before everybody else so you don't have that competition or bidding war. It's always a challenge. You need to be consistent there and create those relationships to be able to get those listings.
And then the way you get the listings, and then you quickly look at the listings and underwrite those as they come in to see if they're worth pursuing. Is that the process for you?
Yeah, so we have different specific metric that we're looking for in terms of returns. We have some investors that brings some capital in our deals. We don't pay all of them by ourselves. It'd be great if we could, but we're not.
Yeah.
And so they're expecting a certain kind of return. So when we look at a property, we look at the actual value, what it could be, and can we forecast a return that can meet that. If we find that property and we can, on the back of the napkin, do the underwriting and it check all the box, the original box, and then we go deeper and then we start proper due diligence and hopefully get it under contract and then proceed that way. Yeah. But and it depends also on the market. Like we're active in the
Yeah.
Kootenays. That's how we connected, and we're active also looking on the island. We're looking in the Alberta markets as well, and so all metrics depends of the market and depends also on the building itself. Is it an older building, a newer building? It all changed there. Yeah.
Yeah, and very quickly, like you say, most bigger deals will always require investment partners. Is there something like you look for really quickly, like a percentage, a return that you'll go, okay, if it's below a certain percentage, it's not worth dealing with. If it's over, it's worth pursuing more. Is that something you look at quickly?
It is definitely on top of our mind because if it doesn't get to a certain degree of return, we are not necessarily interested. It takes a lot of time to put the deal together. It's a lot of work, and we want the return on our time. We're doing it as a business,
Yeah.
so it's very important. We're not purchasing a building just to manage tenants for the goodness of our heart.
So going back to finding your first property in the Kootenays, maybe if you unpack a little bit about how that came about, how you found it, what were the challenges of finding the right property, the right location, the right price, bringing investors on. Maybe you could talk a little bit about that.
Okay, yeah. Originally, we looked at a building in Kimberley, and that didn't go through. And I connected with a realtor in Cranbrook that used to be actually in Kenmore. And so we connected, and he said that right now nobody was buying in Cranbrook, and the market was just starting to pick up. And so he said, I know some owners that wants to sell, but for a few years, but nobody's buying. So we started looking at those
Yeah,
properties, and then that's how basically what they call a pocket deal. That's
yeah,
he presented us to us. We went to look at the property and saw the potential of increasing its value through the income because the rents were going up, but with the tenants laws in BC, it's hard to bring rent up. Even if the market goes up, you have to wait until turnover or such. We saw the big potential there. At that point, I had been learning and doing all those courses and talking to my surrounding as well, people that I knew that wanted to buy a multifamily and that I would probably need some investors. And so I started building in advance a list of potential partners that would want to come in and to put some money in the deal, and having me as basically managing the deal, putting it
yeah.
together, So that's how it came about. And then we were able to close on the first building. It was a 17 unit in Cranbrook. And yeah, since then, the idea with the business plan with this building was to renovate units and try to get the market rent, which was quite effective, but turned out a little slower. So we did those renovation and increased the rent, and then yeah, the values since have been tremendously up, and I think it's been a successful story. Yeah.
That's great. So when this sort of building came up, because 17 units is a good number to start with, did you have any kind of reservations that or were you quite confident in the learning that you'd done and your ability to bring people on as investors and present them with an opportunity that they're obviously going to invest in? How was that process?
I wasn't that confident. We looked at a property in Kimberley beside, and we went through due diligence. I was going to raise capital from investors, a substantial amount. I wanted to make sure I was going to do the proper thing and structure it properly. Yeah. I found a mentor that was helping me out to put the deal together. Okay. So someone that could have ideas, that could pitch those ideas, and he said, good idea or not, or and so, unfortunately, that didn't go through, and we lost the due diligence money. It costs money to do those inspection reports and all that, but eventually we had to let it go.
Right.
But then after that, this was over 50 units. So after that, we felt quite comfortable with 17 units, and already have been going through the whole process of due diligence, only at the last minute having to let it go. At that point, we felt confident. I think having a sounding board to bring your ideas and what's has to be done, like it's a good thing for me. It has been a good thing for me.
Yeah. And one of the things I really understand is investing at any commercial level is a bit of a team sport. You're not going to get anywhere as a lone wolf. So having really good people around you is very important. So where do you find your investors? And then what's the process of actually, literally, how do you get them to go, okay, Joel, I'm going to give you 100 grand to invest? How would you do that?
It's an interesting process, and it's not short as well. I think the most important thing is that they're not investing necessarily in the deal. It does matter, but they're investing in you. So it's a relationship that you have to create. If someone doesn't click with you or your idea or your business plan, or they're not going to invest. It doesn't matter if you're forecasting a 30% return a year or like a 50, like it doesn't matter. If the relationship is not there, it's not going to happen. So for me, from the get-go, I made a conscious decision to start a business doing multifamily. Yeah. I started building that list, building those relationships. I have some good connection friends that have businesses and around here in Kenmore. So I approached those guys to start collecting that. Once we have a deal, we call it a pitch deck, or like a pro forma, where we can try to answer all the questions that may come up from our experience. Then we pitch that to them, and then we're having like often multiple conversation after that, answering question, because the investor will do their own due diligence on you at first and then on the deal itself. That's how we're approaching that.
Yeah. Everything gets finalized through that process.
Yeah, like once they have that, we have a certain structure we're using, the limited partnership structure we're using. Then there's many documents to sign and to verify they're accredited investors. Unfortunately, we cannot take money from anyone, so you have to verify that. It's important for the security commission. After that, we sign those documents, then we transfer the money in trust until we close on the property.
Yeah, I mean, looking back at when you first started to say to yourself, I'm going to get into multifamily, what would you say was a timeline that you gave yourself enough self-learning to actually have the confidence to move forward and make an acquisition?
I started listening to those podcasts, like I said, and reading a few books. And I think what it does have a lot of information to how to do things, how to purchase and all that. But also, like you said, not everybody is comfortable purchasing a $2 million asset. Not everybody has the money. So it's a lot of mindset, like trying to get in the mindset that it's okay and you can do it actually, because it's not always easy. There's a lot of difficult part. And I think what we're doing is to deal with problems. If there's no issue, there might not be any value. So that was a process. And then I did some underwriting course and went to a few forum. And then I had a mentorship program that I was part of for a year or two. I imagine I was about a couple of years learning, and I'm still learning every day, but before I did the first move.
Yeah, and obviously people listening to this might be well versed in real estate and commercial real estate and acquiring property. The underwriting process, how would you describe that, and what are its purposes? What would you say underwriting is, and then what is its purpose as an outcome?
Okay. So underwriting, it's really looking at the income, the expenses, the lending that you might get, like all the numbers to make sure that you're making money instead of losing money. So that's really important. And I think anybody can do this. You need about grade 5 maths. So I don't think it's very complicated at the base of it, but it's really to understand like every expenses that you can have in the building, and then also all the source of income. There's maybe potential income that you haven't seen or that the seller is not taking advantage of to increase that. So the underwriting process give you a sense of, okay, what is the actual value, and also what it can be the future value. As an example, you buy a property in BC where you have most of the rent are still from 5 years ago. They're paying 950 for a 2 bedroom, and but the seller is fine with that. He has the property for 30 years. He's fine with that. He's cash flowing. He's making his money. He's fine. But at the same time, that the market rent is roughly 1,700, and so there is a big disparity between what it's charged. And but the idea here is to buy on actual value, because the building really is valued on what it's making right now. You can have two of the same building side by side. One would be 1 million, one would be 2 million, only because of the income that it's making. The underwriting allows you to have the exact picture of how much it's worth. With knowing your market, knowing the rents, you can bring it to a value that much greater. And so once you figure that out, that's where you can find those great opportunities in the market. That's what most of the underwriting allows you to do.
That's a good definition of it. One of the most important things is to make sure a deal's going to work for your specific scenario. The building that I own in Fern, I did a very similar process, but I was running a different business then, but the acquisition of the real estate kind of was part of it. I didn't look at myself as a real estate investor, but looking back, I did a lot of those things without even understanding what they were. And I'm sure a lot of people do sometimes. They start looking at, thinking about getting into real estate. They start looking at things and not realizing that what they're actually looking at is very important in the process, probably the start of the process as well.
Yeah, I think everybody can understand that process for sure. And I think it gets much easier as you see more building, and then you start forming rules of thumb. Let's say expenses for that age of building. If you pay utilities, then it should be about 50%. Right. And then, okay, I can get probably a loan of that much with debt service ratio. And so those rule of thumb start coming, and then the underwriting gets much easier. And it's okay like to buy a building at max rent or things like that. But something to keep in mind, if you buy a building that has already maximum rents, and that you buy it at that value, what if the market goes down, you got a recession or something, you have no more buffer to keep you above. Now you're starting to lose money. So that's why we go with the value add strategy. There's more security, since we know we're already under rented and underproducing in terms of income.
Information, Joel. One question I did have: the property they did buy in Cranbrook, wasn't it? The one, the 17 unit. Yeah. How did you? Because it's a value add. What were some of the strategies to work around? Because we have some very strict tenancy rules here about upgrading the building whilst managing the tenants.
There's many strategies out there that do cash for keys, where you give cash for them physically. We decided to keep it more organically. It is a community, a smaller community. We get well known. Now we have that one, but we have multiple property now in Cranbrook. And so we decided just to keep it as natural as possible. So if someone leave, then we're going to implement our renovation so we can get to market rent. But not before that. We're not trying to push anybody out or anything like that. But there's definitely more strategies out there. That's just the approach we decided.
Yeah, sure. These is places where people live, so you have to be mindful of people's homes. And all these sort of things obviously factored in to the initial kind of presentation for the investors. This is everything taken into account at this point before you start writing contracts for the actual property.
We try to paint the most exact picture of what we're forecasting, and then we convey that to the investor. We have a specific business plan. Here's our projection with the rent, and we're not thinking that we're going to renovate all the 17 units within 12 months. We knew that we could have 2 or 3 units a year, and so that's where we have base our projection on. We're really realistic with what we've done, and we like to under promise. And
are there still deals out there like Cranbrook? Can people still get those type of deals in this market?
Yeah, I think the Kootenays in general, you still have like great opportunities. I think most of the owners are still what they call mom and pop. They're not necessarily like the big Broad Street kind of people. So I think there's still lots of opportunity. Before COVID and with COVID, we saw a lot of transaction, I think, in the Kootenays. A lot of properties have transacted since the value have come up. I think the Kootenays since 2008 was very flat and nothing happened much on the rental market. That's where you started like seeing the rents and everything come up. So it got a lot of the attention of the bigger guys. I don't consider myself a big guy, but there was a lot of opportunity there. I think there's still lots of opportunity. We're still looking. It's just less is transacting.
Listen, it's been fantastic and fascinating chatting with you for the last half an hour, Joel. For you to maybe summarize getting into multifamily and getting going, what has it meant for you and what has it given you? And is it everything that you thought it would be? Is it more challenging?
We've been told at first that it was a fairly passive thing, investing in real estate. It's none of that. Although we're not even doing the actual day-to-day management, we have managers for that. It's still lots of work. But really, I wouldn't do it otherwise. I think the process we've been doing worked, and we're very happy. Our investors are happy. In summary, you should definitely get to know the numbers, try to see a lot of deals, get on the list of the brokers so they can send you the deals. If you need to raise capital, start to talk about potential investor or partners early. There's many problems that arise, but there's always a solution. I think that's why not everybody does it. Look for those solutions. There's always a solution, and it is not a single party. Like you need a lot of partners, like brokers like you. We need the mortgage brokers, we need appraisers, we need so many third-party professionals. Respect their time. It's important because they are paid if you close the deal. You have to respect that. They're gonna vet you as much as you're gonna vet them. Build those relationships, and then off to the races. Know your numbers to make sure you know what you're buying, and always keep the exit in mind as well.
That's awesome. Maybe we'll invite you back and we can talk about another aspect or area of this fascinating process. But thanks again for your time, Joel. I appreciate you coming on the podcast.
Thank you, Phil.